Welcome to the continuation of recording of business transactions. So, in the previous video, we discussed that the procedure for recording a business transaction involves the generation of a source document. In case if you buy something, it's a receipt. After that, there is the identifying of the accounts that are involved in the transaction. Then once those are identified, the exact details and amounts are supposed to be recorded in the identified accounts in the what are called subsidiary books. So these subsidiary books are part of the ledger, and they have the different types of accounts. A ledger is just a collection of accounts. So a ledger has different types of subsidiary books, each subsidiary book having different accounts. With that being said, in this video, we're going to discuss how to identify the accounts that are involved in a business transaction and how to record the amounts and the details in the identified accounts. So according to the dual aspect concept, every transaction affects the position of the business in two ways. So the two accounts should be identified, classified, and recorded appropriately, like I mentioned earlier. The double entry rule applies. Okay, so the double entry rule applies in this way. But first, the rule, which is the double entry rule, states that for every debit entry, there must be a corresponding credit entry. So this double entry rule is connected to the dual aspect of accounts, which is one of the concepts we discussed in the first video. Okay, so the double entry rule states that for every debit entry, there must be a corresponding credit entry. So in any transaction, if one account has been debited, then there must be another account somewhere which should be credited. Okay. Note also that this rule applies differently on the three classes of accounts. So on personal accounts, real accounts, nominal accounts, this rule is the same, but the way you perceive it is a bit different, as you are going to see. But it all goes down to the fact that one account is going to be debited and the other account is going to be credited. So now, how is the double entry rule apply for real accounts? So for real accounts, you debit what comes in and you credit. You debit what comes in or the increase in value. So if there's an account that has experienced some value coming into it or increasing in value, you debit that account. And if there's an account that has experienced a value going out of it or decrease in value, you credit that account. So for all personal accounts, you debit the receiver and you credit the giver. So the personal account that is receiving, you debit it, and the personal account that is giving, you credit it. And finally, there's nominal accounts, which will sound a bit opposite of the first two. The first two, they all feel like an account that is receiving something is going to be debited, and an account that is giving something is going to be credited. That's true even for nominal accounts, but okay, let me first show you how you debit or credit nominal accounts. So remember, nominal accounts normally can be broken down into two: expenses and losses versus gains, incomes, and the likes. Okay, so nominal accounts, you can see them to be of two types which have different behaviors. So for expenses and losses, you debit. Then for incomes, gains, liabilities, you credit. So it might be difficult maybe for you to wrap your head around this, but you can take it as that's how nominal accounts behave. You debit expenses and losses, and you credit incomes, gains, and liabilities. So let's take a look at examples of transactions and how to deal with them. So the first type of transaction that we're going to look at is a cash transaction. So a cash transaction is a transaction that involves immediate cash. So it reads, on the 1st of June 2017, sold goods to P3 cash. So the first job is to identify the accounts that are involved. So goods were sold. There's always an account that monitors the selling of goods called the sales account. So that's the first account. Cash was received. So there's also a cash account. So sales account, cash account are the accounts that are involved here. Who is going to be debited and who is going to be credited? So sales account had some goods for sale. So they were sold, mean that value value reduced or value went out of the sales account. Therefore, sales account is going to be credited. Then cash was received, mean that value came in. Therefore, cash account is going to be debited. So to record this transaction, we draw a table. We'll start with the cash account. So we write the title cash account. Then this is how to draw a table. So the table is going to be made of the column for date. We write the date on which the transaction took place, details or particulars. So we say that we received cash from sales or received value from sales. Then there's always a column called for your column, which I'm going to explain the use when we reach the part where we're going to make use of it. Then on the debit side, the K represents the currency kwacha. Then this far right is the credit side, where there is also a K for kwacha, meaning that whatever number I'm going to write here, it's in kwacha. So on the left here, since we have said the cash account is going to receive, so we have debited to pin 3. So it means you have recorded this transaction. But of course, there is always for every debit entry, there must be a corresponding credit entry. So there must be another account which should be credited, which we discussed to be sales account. So again, we're going to draw an account for sales. We'll draw our table in the same way. The detail is going to be cash. So we give value to cash. So value moved from debit, from cash from sales account to cash account. So the value that was given, we put here credit. Okay, so sales account gave away a value which was worth 2,300. Then cash received a value which was worth 2,300. We go to a bank transaction. It reads, on the 2nd of June 2017, bought goods for resale at 4,000 by check. So goods were bought so that they are sold at 4,000 by check. Okay, so this statement for resale, it means it is here to help us know if these goods were bought for business, or for selling, or for keeping. If it's for keeping, then they are fixed assets, but if it's for selling, then they are current assets. Okay, so bought goods for resale at 4,000 by check. So these goods were bought. What kind of accounts are involved here? So they are, of course, bought. It means there is a purchases account here. Of course, the resale can maybe tempt you to think there is a sales account, but the sale has not yet happened. So we bought goods, so there's a purchases account. Okay, buying its purchases. Okay, and also there is the bank account because of this check which was involved. So we have identified the accounts: bank account, and purchases account. Which one is receiving? So the bank account gave away a value of 4,000, while the purchases is going to receive goods with 4,000. So we can say, starting with the bank account, we're going to draw the table. So particulars, purchases, sorry, the date is supposed to be 2nd, and of course the bank account gave away 4,000. So I'm going to write another account for purchases, where we're going to debit purchases because it received 4,000. So when we do that, we're going to have this. Next, look at a credit transaction, a transaction that does not involve cash. So usually this transaction will involve a personal account. There must be a company or a person involved. So on the 3rd of June, bought goods on credit from H Banda at 3 pin. So what accounts are involved here? Okay, bought, it means there's a purchases account, but it's on credit. Okay, no cash or money from the bank has been paid. So we have purchases account and H Banda's account. There's an account for H Banda which gave us these goods which are valued at 3 pin, and the purchases account that received. So H Banda who gave, we're going to record 3,000 because he gave away 3,000. Then of course particulars is purchases. Then the purchases account is going to receive this 3,000. So purchases account received 3,000 from H Banda. Next, we go to a very interesting type of transaction called contra transaction. So contra transaction basically involves goods or value moving within the department from this account to this account. So on the 4th of June, withdrew cash from bank 1,000. So be careful. This withdraw is the business that withdrew cash. Sometimes it can be the owner withdrawing cash. That's a different scenario. Okay, so in this case where cash was taken from the bank, meaning that the bank account gave away money and the cash account received money. So the two types of accounts that are involved are bank account and cash account. Okay, so this is a contra transaction because there's no any other business that our business is dealing with in this transaction. It's just our business money moving from one account to another. It can also happen that maybe you have some fixed asset that you are keeping, which are in the fixed asset account. Then you want to you want to sell them, so you take them to sales account. That is also another example of a contra transaction. So the one that you shouldn't be confusing with this is owner withdraws cash from the bank. So the bank account will give cash, but that cash is not going to the business, going to the owner, who is different from the business according to the concept of accounts, which says that the business and its owner are two separate entities. So that one, it's a withdraw. There is an account which deals with that, which monitors that, called a drawings account. So a drawings account is the one that is going to be used, a drawings account and a bank account, if the owner takes money from the bank for personal use. But this is not for personal use. So this money moves from the bank account to the cash account. So the bank account is giving away 1,000, meaning that's going to be credited. The cash account is receiving 1,000, meaning that's going to be debited. So bank account, particular cash, then 1,000, and cash account receives 1,000. So this marks the end of this lesson. Hope you'll be able to record whatever business transaction you're going to face after this discussion. Always think who is going to receive, who is going to give. Let's picture a simple one which I forgot to add as part of the examples. Let's say paid rent by cash. What transactions are involved? There is a cash account and a rent account. Cash is giving away the money, the rent account is receiving the money. Hope now it's clear why expenses and losses when it comes to nominal accounts are supposed to be debited. Happy solving.